All right, so let's get into a live stream today and break down a little bit about what's happening with the CPI, whether or not this will come in hotter than expected, or could it be in a position where it starts to shift some of the crypto market. I'll talk to you guys a little bit about that today. Don't miss it. My name is Paul Barrow. Welcome back into Tech Path. All right, a couple things I want to get into, and that is Tangem, self-custody. One thing that you do want to do is jump into self-custody today because that's the best way to make sure that you're in control of your own coins. And I think this is something that a lot of people kind of overlook. Maybe you're brand new to crypto and you're thinking, I'll just leave it on Coinbase or on whatever exchange you're using out there. But the first time you really want to maybe look at a long-term hold, self-custody is going to be the step. So just visit tangem.com. You, of course, can get right there. It is one of the best and most secure wallets out there. As you can see right here, it's a pretty slick experience with the card and the app all working in unison. Make sure and just click the Get Tangem button, and that will get you to the 3-card set. Use that one and our link down below. It'll give you an additional discount, and it helps the channel. All right, so a couple of points I want to get to. First up is the big report of the day, and that, of course, was Mr. Jamie Dimon, who puts out his investor letter every year. It's kind of like Larry Fink with his BlackRock letter. And it's one that starts to give his investors an outlook on various things, mostly global, macroeconomic, along with what's happening here in the U.S., along with the political comparison, what we think, from what he thinks from a geopolitical standpoint. So right now he's warning that the U.S. interest rates could soar to as much as 8%. This would be a significant up from where we are right now. And this could be coming over the next few years. So what he's looking at is that just wait a minute, maybe the soft landing isn't necessarily in the cards. So a lot of risk here around inflation. I'll explain some of the things around that, and we'll get into that today. But the big key data point that we're watching for right now is tomorrow's CPI number. The reason this one is so important is because it's the March CPI, and it's really the first CPI that will come in that isn't influenced by the seasonality, first a year, the holiday CPI, all those variables. This is a true, I think, a true reading of the American economy. So it's going to be one to watch for sure. I want to get into Tom Lee and a clip from him, and I'll explain a little bit more after the clip, but take a look.
Dimon writes the following. He says that despite the, quote, unsettling landscape, war in the Middle East and Ukraine, growing geopolitical tensions in China and polarized electorate here in the U.S., that the U.S. economy, he thinks, continues to be resilient with consumers still spending. He says the market seems to be pricing in a 70 to 80% chance of a soft landing, but Dimon thinks the odds are, quote, a lot lower. He cites persistent inflationary pressures, including what he says are, quote, ongoing fiscal spending, remilitarization of the world, restructuring of global trade and capital needs of the new green economy. Another major theme in the letter is artificial intelligence. Dimon writing that the consequences will be extraordinary. He says J.P. Morgan Chase has grown its AI organization, quote, materially with more than 2,000 machine learning experts or data scientists now on the payroll. Dimon also issuing a warning, quote, we may be entering one of the most treacherous geopolitical eras since World War II. He said he's also concerned about the large deficit supported by quantitative easing.
Maybe we're going to ask Tom about that right now.
Well, Tom's been the bull, though. Yeah. Tom's been on the other side of this, Tom. What do you think?
I think Jamie's doing his shareholders justice, but at the end of the day, when it comes to markets, I think markets tend to price concerns very quickly. I mean, I think that's really been the concern for the last 2 years is a hard landing. And now that inflationary pressures are easing at a time when consumers don't have a lot of leverage, there's all this, there's $6 trillion of cash on the sidelines. And inflation, we don't really know how quickly it's going to fall, but our bet at Fundstrat is that it's going to fall pretty quickly, means some of the concerns he listed about a hard landing are because of sticky inflation. And if it's softer, I think we're going to have quite a good economy.
All right, so you heard both sides of the story. If this does come in hotter, then Tom Lee is wrong. If it comes in softer, then Tom Lee is right and Dimon is wrong. And in a nutshell of the early stages of how an economy could correct, a couple of things that Dimon points out, though, is remilitarization. That's going to happen anyway. in the sense that it's going to drive the industrial military complex. We're going to continue to see growth in that market. AI, I think, is the big, productivity winner here, and that's going to have some effect in the crypto markets as well. So there's a lot of, kind of balances that are happening globally, and I think the one that most people would agree is, just this continued conflict, because we don't really know what that's going to spill over into, especially with what's happening in Israel and Gaza. Those are I would say, more of the hot kinetic wars that are out there that could have a lot of factor in the global economic condition of the planet. So that's the one area that I'm a little bit concerned on. Now, the point is whether or not they cut rates, because a lot of people are still looking at rate cuts toward the end of the year, maybe in Q3. And Lee has a different spin on this, that we might be seeing a market that continues to rise without a rate cut. Listen in.
I know you'd been telling people kind of buy on the dip, not that there's been much of a dip if you're just talking about a pullback of a few percent. Does it matter if the Fed cuts rates or not? If the economy is really strong anyway, will earnings be able to justify the valuations at this point?
I think the Fed being supportive of the economy, so managing the business cycle, is the most important thing. In the last 2 years, the Fed was fighting inflation and therefore hawkish. That was tough for equities. But if we're in a mode where the Fed doesn't know how many cuts it needs to make, but it actually wants to support the business cycle, that's good for stocks. So I don't think you need to have 3 rate cuts. You could even have a good scenario where the Fed only cuts once. I think that there's many reasons that we still think there's gas in the tank in this rally. Part of it is that we do think the inflation trajectory is on a glide path lower than consensus expects. As long as investors are top calling and are really looking at the world half empty, I think stocks can still rise on this wall of worry.
Yeah, and I think the wall of worry is an area that people are still considering. The one thing that he said that is still, I think, a very valid point is that there's just a wall of cash, $6 trillion on the sidelines, likelihood that would activate pretty quickly, because a lot of people have been trying to buy these dips. Now, if you look at the S&P, and really where it has been since November, I'll go back down here to the dip in November of where we're trading today right now at about 51.70. That's a 26% up. And you look at this, most people have not seen these kind of returns in a very, very long, in some cases, their entire lifetime. Now, granted, I know everybody's going to say, hey, Paul, this is a crypto channel. But S&P 500, the S&P 500 has a lot of bearing on how market liquidity is moved into risk assets. And that's the thing that you have to kind of compare against what's happening out there. You look at the CPI expectations for tomorrow. Here they are. And I will say this, that most of the time these banks are wrong. So, many people are still looking at this in a position where if it comes in around the 3.4, which is really kind of the expectation, pretty much everybody's on 3.4 with exception of Bank of America at 3.3. But if it does come in at 3.4, most banks expect it could mark the third straight monthly increase in inflation. And median expectations are a 0.3 month over month. So that would be a very interesting point, when you look at the market in general. If it comes in hotter, some people are going this direction, then this is maybe why we're seeing a little bit of a cool down in the market today, especially in the crypto market, after a big day on the Coinbase news. So if you didn't catch our Coinbase video, go back and watch that. That's the bigger news, I think, that is a much longer term outlook here on what digital assets are doing as a whole. And maybe it's the first time you've had a chance to come to our channel. I would suggest that you watch yesterday's video, the Coinbase Live video, because it's a good one that breaks down why this is an area that you need to really pay attention to in terms of future asset, especially if you're looking at, the issue of de-dollarization, meaning inflation continuing to devalue what your dollar is worth. Here's Mike Novogratz. Call me crazy. I don't see one good reason for the Fed to cut rates, yet I think they will. It's a great setup for Bitcoin, gold, silver. We've talked about this before, especially in the commodity side. It's not a great setup for the U.S., though, because we need a politician who's going to cut spending. And this is the problem that we have in just national debt. And what we've continued to see in printing literally trillions almost every 100 days, that's most likely going to start to cycle into every 60, maybe even to every 30 days. If you could imagine that, $1 trillion in debt every 30 days. Right now, we're moving in at about every 100 days. Here's the chief economic advisor over at CNBC, and he goes in a little bit more around how the Fed should structure this, because this is a big deal All this will depend in, and it'll make sense here in a minute on where this plays into crypto. Listen it.
What they should be thinking about is the dual mandate and what is the right inflation target. Or if you want to be sort of more diplomatic, when do you want to get to 2%? Do we need to get to 2% quickly? Or can we get there over the medium term? And if you notice, a very important descriptor has come into. Whenever they talk about 2%, they say the longer term objective of.
Larry Summers has been pretty critical, too. He is saying they shouldn't do anything right now because we can't even decide on what a neutral rate is. I just heard him saying that if you don't know what the neutral rate is, that's like driving a car and not knowing what your speedometer says. You just don't know how fast this economy should be running at this point, and that's a reason for doing nothing.
Yeah, Larry reacted quite violently to the comments of Chair Powell last week, when Chair Powell said, we don't know where our start is. And Larry's point, which is correct, is, well, you better have some view as to where our start is. Again, that is an illustration of a Fed that's too data dependent, that is not looking at the strategic element. Of course, you have to have a view of where our start is. That's so critical to your path.
So his point, and I would agree, is that, this is something we've talked about here on the channel a lot, is will you ever reach a 2% again? Is it possible that, maybe that 2.5 to 3 is the hot zone that becomes the new standard for the Fed? I understand the Fed and their tenacity to get to that 2%. That's Powell's pretty much mission in life, but he can't do it at the expense of ruining a global economy. Because really, when you look at the, U.S. economy that has such a derivative nature on the global economy. So it does play out into what Mohammed was talking about. Let's go a little bit further into this, because the point on how they should anchor this and look at more of a long-term view is pretty significant, because this will have an effect, especially on Bitcoin and Ethereum, I think, because that's the alternative asset to a lot of what's happening in the traditional markets. Listen into this clip.
We kind of know the direction of things, but I think everybody's looking for any cue anywhere to try and figure out what the Fed will do next, because it's just unclear.
Yeah, and there's a couple of things going on. One, I think the whole notion of transparency is being implemented in the wrong way. I'm all for transparency, but it has to be in a way that fulfills the objectives of
transparency, but nobody's allowed to talk?
No, just talk, but talk with a longer-term view. Don't talk on every single change. And the other thing is, this Fed, unfortunately, has become excessively data dependent. And when you become excessively data dependent, you start being swung around by the data. There's an old image that...
But shouldn't you be excessively dependent on the data? Shouldn't that be the whole game? No,
high-frequency data tends to be incredibly noisy. So if you're excessively data dependent, the image you have is of a roller coaster. The markets, the data, the high-frequency data on a roller coaster. And the Fed has two choices, either to get onto the roller coaster or stay on the side and try to provide the anchor.
So your argument was that they should do nothing right now and kind of wait it out and see where the data heads? Or
No. If you take a strategic view of the economy, they should definitely cut twice. If you are overly data dependent, you're going to be taken to a place where you may end up not cutting.
So good points, but I'm going to kind of disagree in the sense that, yes, highly data dependent. Yeah, this is causing these ebb and flows within the markets. But really, if you look at it, I mean, the S&P again ups 25% in that same period of time. If you go back here and look at where Bitcoin was back here in November, and we'll swing back out here to November, it's a different point right here. We'll go up into where we're trading right now. Nice 90% move. So could those is that really a volatile market since November, since we saw kind of the correction and the promise of a Fed rate cut? It's pretty much just been up and to the right now. So I think the point he's getting at is they just need to back off the gas, let the market kind of dictate, which is really what's been happening, because there's these ebb and flows. And I think that will probably be the case tomorrow when we get either a soft CPI number or a hot CPI number. What it may be. So let me know what you guys think in the poll, because I'd like to get your feedback. Don't forget to drop some questions in. We'll try to get to a handful of those before we buzz out of here. I got some more here for you that will give you some insight as to where this market is going to be going. But make sure and smash the like button, because it is one of the things that does help us get feedback on what works on the live streams out there. I want to jump over to this tweet right here. Let me kind of jump out of it, and I'll zoom in on this right here. Interest payments on U.S. debt continues to hit record highs. unfolding as the 10-year yield could climb to a 16-year high, 5%. This is one of the most shocking charts I've seen in a long time. And I want to go to this, and I'm going to zoom out. If this was your interest rate payment, you would probably have a meltdown and most likely would have to commit bankruptcy. And I say it in that sense of not funny. This is a big deal for us to see this kind of accelerant. If you go back here into 2008, that's that gray bar that I'm kind of hovering over right there. That was the last major recession we had. And look at that dip right there in 2008 to 10. Normal. This is the kind of move we've seen. And this right here is the recession, supposedly, that we're in right now. Normal, and this massive skyrocketing. This is the roll-on effect that the economy has when your debt continues to spiral out of control, which is the problem, much bigger than everything else. So what does that mean? Well, it means de-dollarization. It means BRICS nations are going to continue to get control, and it means Bitcoin, Ethereum, digital assets are going to start to take the lion's share. This is why you've seen an ETF absolutely just go off the chart. Here's billionaire Arthur Hayes. I don't know if he's a billionaire, but he says he is. Says Bitcoin halving price action could have before and after halving could be negative. This is pretty typical of what we'll see. Many experts anticipate significant rally following the halving. Remember, we talked about this the other day, is most of the time it's either sideways or slightly down before we see those moves. This could be accentuated a little bit depending on the market. Hayes explained that the anticipated reduction of the pace of QT, back to our point, is favorable for dollar liquidity as the decline in the Fed's balance sheet slows. He also sees May 1 as a turning point, marking this the end of a very unusual period for risky assets. And it could return liquidity as Janet Yellen and the Fed take measures to boost asset prices. This will be something that flows into, guess what? The next election. And that is important because May to June, we start to see a lot of these conferences and these political moves and ploys starting to play out, including what will happen on the Democratic Party for sure. Bitcoin, of course, analysis, ICPI, as whales are pressuring Bitcoin price below 69. So we could see a little bit more of a push down on Bitcoin, even though we had a really hot sentiment yesterday for Bitcoin, Ethereum. But when you looked at the sentiment last night, it was very short-lived. And I think a lot of people were starting to look into the CPI. So that's the big one right now that could be some downside push here for sure. Bulls continue to lack momentum, reclaim a further ground toward current all-time high. Bulls aren't holding on. If Wednesday's core inflation numbers are hot, they'll likely extend to the downside move. That's where we could see that 69K come in. However, what happens if in these scenarios the whales long this and the dip and they exploit the upside liquidity? This is where they get to kind of play both sides of the game here. So most people aren't looking at it this way. You might just be saying, hey, I'm going to hold. And if do I get a chance to buy the dip? If I do, great. I buy a dip and I move again because I'm looking at long-term holding. Because I think most people following our channel are in that point. Now, on the positive side of Dimon's letter, this was the report. It was on page 17. And I'm going to zoom in on this section right here. It says, while we do not know the full effect or the precise rate in which AI will change our business or how it will affect society at large, we are completely convinced the consequences will be extraordinary, as possibly transformational as some of the major technological innovations. Hence, internet, social media, mobile computing, you name it. Those are the kind of things. Likelihood is AI. And I believe blockchain will enter into that because of the potential problems that AI will represent to society. Blockchain will become that true immutable ledger, which is what it's designed for, to create authenticity, media centralization in terms of what's authentic, what's not. All those kind of things will play into this in the future. That's the positive side of this. Because all that plays into, guess what? Compute tokens, all of the AI projects out there. You're looking at PAL, you look at Akash, you look at Render. I mean, there's many projects that are already moving in that direction. So pretty big deal. Then you look at the tokenization side. Now, here is the leader of Avalanche. This is Emin Gunserer, and he talks a little bit more around where Avalanche and Onyx are connecting. Listen in.
It's absolutely essential to be able to support institutions' compliance requirements. the world is not going to go overnight into a libertarian paradise, if it ever will. So there are reasons why societies enact certain rules that pertain to them. And there are things that you need to do differently in the United States than the way you would do them in the EU, than the way you would do them in Russia, than the way you would do them in China, than the way you would do them in Japan or India. Each and every one of these societies has different rule sets to which people have to comply. And now those institutions, the compliant institutions, are typically in charge of trillions of dollars of assets, and they found it difficult to put those assets on these one-size-fits-all chains. It's okay to us that people in Manhattan, people on Wall Street, just right outside here, have different requirements. We can accommodate them. And we've been working with JP Morgan, with Apollo, with BlackRock to build systems that are compliant, to build chains tailored to their use cases that are compliant. And I'm really proud of those efforts. And I'm really proud of the way we've been trying to bring real world assets onto the chains in a compliant manner.
So Min has hit on this a lot over the past bit, and when you look at both private and public blockchains, what JP Morgan is doing with Onyx, what BlackRock, which is doing it with Securitize, with Ethereum. So you have a revolution taking place in Wall Street. And this revolution is really riding on blockchain technology, which means you're going to have a lot of these derivatives and other assets that start to spin up out of this, including AI projects. We'll see this in compute, all that kind of stuff that I was talking about earlier, along with what we'll see in the general crypto markets, altcoins, meme coins, gaming coins, all of those types of projects that really flow into this. And I think represent what is and will be digital assets for the future. The good thing is Wall Street's in. The ETH ETF, very, very popular. This last clip right here, he goes into a little bit about the value, because we could be at a point right now. I know we all think it might be, high priced as Bitcoin is today, but listen to what Amen had to say about that.
I think that the entire space is incredibly undervalued, and the regulators miscalculated, and the space is too big, and the functionality it brings, the new things you can do here are just too valuable. And if anybody has any experience on Wall Street with what they actually use for accounting, what they use for reconciliation, what they use for automated services, what we can do in crypto is miles ahead of it. So there is still some social backlash, and people don't quite see the value. And in fact, a lot of the anti-crypto arguments I hear are really arguments against the systems from, let's say, 5-6 years ago. They are not caught up. They don't know what a smart contract chain can do for them. They haven't really seen a lending platform and how easy it is to use. They don't understand the efficiencies that flash loans can bring to finance. So these are really amazing. And they don't understand the democratization that this space brings. I don't think it has sunk in yet that crypto is here to stay, and it's so much better. So the valuation of the entire space, I think at this point in time, is missing a 0 or 2. So we are way below where we could be if people realize the societal impact that this space could have.
And I think he's right. This is the point that Wall Street is very, very early, and they're starting to get it. They're kind of in on it now. And I think we have still not seen that mass adoption. So that's the one thing that still has to occur, from Main Street to really make this go into a multi-trillion-dollar market. And if you look at level of consumer trust in crypto right now, there's a report out there that says, hey, most likely is that consumers trust in cryptocurrencies, notably Bitcoin, which is seeing an uptick in a recent Deutsche Bank survey. Now, one thing about this is, again, Deutsche Bank, okay, we get that. That's one survey. But if I look at just, some of the Google Trends out there, this is Google Trends right here on Bitcoin. Continuing to climb. This is the last 12 months, so you can kind of see it back here, but it's starting to move up here recently. So that tells me that retail is starting to step in here. Now, it's happened really since around December, but we're at our highest point here on early March, and sliding off, most likely we'll start to see a little bit more. If you look at that in comparison to the last 5 years, this is a very interesting point, because if you go back in here to Remember this area right here? This right here was the last bull run right before it. And then, of course, right there is when we started to see the end of that bull run. But this was the pre-run that identified what was going to happen in November and October of 2021, which was really the last time we saw all-time highs. So a lot still kind of moving in this direction. Definitely one to watch in terms of sentiment and new people coming into the market. So I think this will be a key going forward. All right, a couple other things. Average retail investor portfolio drawdown. This is kind of heartbreaking. From 2022 peak was around 35%. It took a year and a half to recover. In comparison, the S&P 500 bottomed after falling as much as 25% in 22. This means that retail investors are just now breaking even with the 2022 peak. However, when you account for inflation, they're actually losing money. So this is the point that I talk about with TradFi. And this is something I talk about people all the time. If you're going to try to compete with the Joneses, and the Joneses really are inflation and the de-dollarization of our economy, there's only one route that you can take, and that is risk assets. It's really the only thing that's going to keep up with it. Otherwise, it's just going to see a continued decline in the value of the dollar versus what you can go at it. And this is a good example of where that's going. So I don't know, guys. Americans spent over $113 billion on lottery tickets last year. Well, that tells you how risky it is out there. If they're willing to go that far to spend on $113 billion on lottery tickets, imagine if they just bought a couple of, Satoshis, a little bit of Bitcoin, a little bit of ETH, a little bit of Polygon, whatever you like, whatever your digital asset is out there. All right, we'll get to some questions. I know you guys have a poll that you've got into. Let's take a look at the poll real quick. All right, here we go. Will CPI data crash Bitcoin tomorrow? Everybody's saying no. So, well, not everybody. 57% of you say no, which means you're anticipating a softer CPI. That's good because that shows optimism. Future is bright, as BBD would say. Yeah, future is bright. All right, let's get to a few questions, and then we'll kind of come in on that. Once Wall Street can trade and make all these fees instant, it's game over for crypto. I disagree with that. Gen Z is way more likely to buy crypto. It's only a matter of time. I do agree with that, but I think Wall Street, it's going to be a long time before we see Wall Street truly take a large percentage. When I say a typical crypto investor might be 5 to 15% of the portfolio, a typical crypto investor, a really, OG hodl investor is probably in the 40 to 60% range of a portfolio, and they're still diversified into other things. But Wall Street, 5% to me is about as deep as I think they're going to go in the next 5, maybe 10 years. And a lot of that is going to continue to push down. So I don't know. I'm not sure I agree with that. Flash crash right before halving would be a godsend. Could happen. I mean, if you're holding and you're thinking long-term here, which is kind of how I do it, I'm always looking for those kind of opportunities. One thing you can do on whatever exchange you're rolling out on is drop in those orders and put them at ridiculous numbers. I know it commits, capital, but put them in there because you never know if you get one that dips in there and you slice and get a good grab. So something to watch. Let's see here. Bitcoin doesn't care for sure. Inflation may not be climbing as much as last year, but prices sure aren't reducing. I totally agree with that. Also, I believe GDP is only showing growth in reflection of realized inflation. I think that's a good point, Matthew. And I think, when you look at inflation as a whole, because remember, inflation is very structured coming out of the Fed, meaning they get to pick and choose what they get to select as this is what inflation is. But if you look at Trueflation, go back to the Trueflation website, you'll start to see some interesting things develop over time. And if you compare that to what we normally see on the CPI, a little different story for sure. Tens are listed on Coinbase. Yeah, that was something we brought out yesterday. That was kind of an interesting point. This is a good point right here, Stephen, is that there's going to be, with Coinbase's win on digital assets, basically secondary market sales not being, securities, that could really start to blow up Coinbase and other exchanges out there to accelerate listings, which means more digital assets for you guys and me. What RWA projects are you bullish on? Well, anything Avalanche, I'm just like that. It's one of the core tokens that I feel like starts to work its way through. There are several other that we've mentioned here on the show. We probably should do a whole playlist on real world assets and some of the projects that are starting to work into that area. But my number one would be AVAX. Jamie Dimon is the ultimate clown. He's the pet rock guy. Remember, he will always go down in history as the pet rock. Bitcoin is the pet rock. So if he's wrong, he will always be the pet rock guy. If he's right, guess what? That's not good. China Bitcoin ETF coming on. Buckle up. Yeah and no. But there will be some stuff, I think, happening in Asia. We did a whole video on this around stablecoin in Japan, really more around the ecosystem of what digital assets and the next generation web economy is going to look like, Web3, which is a good one. All right. Your Bitcoin could be your savings account. This is or it could be your Ethereum. It could be your NFTs. I know NFTs are very volatile, but many people, if you only have 5% of your liquidity or your portfolio in something like that, that's a good mix. Not financial advice, but I look at it this way. Diversification right now is starting to shrink because diversification is really better after you've achieved a certain level of wealth. Centralization is better when you're trying to achieve it. So really focusing in on one area, like digital assets as a whole. That's a good centralized area for sure. All right, thanks for coming in on the live stream today. If you're not part of the Diamond Circle, make sure and get in right now. It's a great place to get additional content. If you're not following me on X, catch me out there. It's just @Paul Barron. We'll catch you next time right here on Tech Bath.